Welcome back, everybody. At the beginning of February, stocks were flying high. My portfolio was at all-time highs, my tech stocks were crushing it every single day, and then, things changed. Over the last week, the stock market and tech stocks in particular are getting hammered, and it seems like the volatility is just crazy out there. Plus, NVDA and Snowflake just reported solid earnings, but will it be enough to turn the tide for those two stocks? And lastly, we'll talk about one of my favorite companies, Amazon, as they announced Alexa Plus with a pretty cool demo, as AI assistants / friends continue to become a reality. So let's go ahead and get started. Let's start with tech stocks. Now, over the last week, they're getting killed, and you can just see it in my own portfolio. Cloudflare and Snowflake down around a whopping 15% in a week, NVIDIA down 9%, Meta down 8%, TSM, Amex, and Amazon all down over 6%. So clearly that all-time high portfolio value has taken a hit, and all the market bears who have been calling for a correction since 2023 are like, but is it actually time to worry? And now the real question people want to know is this the beginning of a longer downtrend similar to what we had in 2022? And the short answer to that is, well, I don't know. And the reality is that nobody really knows. But what I'd like to do is try to think about it logically to help ourselves deal with that uncertainty. So let's take a look at it from a fundamentals perspective, a technical perspective, and just a practical perspective. Now, from a fundamentals perspective, the easiest question to ask ourselves is, has anything actually changed with the companies in your portfolio? Now, for example, Cloudflare is down 15% in a week, but has the business actually changed? Well, no, right? The reasons why I bought Cloudflare are all still there. The stock just went up a bunch after earnings and now is coming down a bit. But the vision for what I had when I invested in them to begin with hasn't really changed, so I'm not going to worry about it. I already know it's a volatile stock and it could have some wide price swings, but I'm confident in the analysis that I did, and we'll just see where it ends up over time. And the same is true of every other stock that's down a bunch, whether that's NVIDIA or Meta. The changes in the price don't really bother me if the fundamentals that I bought into to begin with are still there. Now, you could say that the market overall is pricey, and that's a risk, but if you're buying individual stocks, it's something that you evaluate for each individual stock you buy, regardless of what the market as a whole is doing. Now, if we want to look at it from a technical perspective, yes, things have definitely been running hot. We followed up a 20% plus gain market year in 2023 with another 20% plus gain market year in 2024. And that's one reason why people are calling for a correction, because it just can't possibly last. And on some level, that's true because stocks don't go up and down in a straight line. Unless, of course, your name is Walmart right after I sold out of it. So look, it's reasonable to expect the market and certain stocks to cool off a bit. And that's exactly why I trimmed my Cloudflare position after it basically doubled in 6 months. I mean, at that point, I'm just kind of playing the percentages, saying, look, I got this gift of this stock doubling in 6 months, and I'm going to take a little bit of profits off the table just because things don't go up and down in a straight line. And remember, whether you believe in fundamentals or technical factors or some combination of both, everything we do in investing is about probabilities and understanding that sometimes those probabilities turn out the way we expect and sometimes they don't. But one thing is absolutely certain. Stocks are going to go up and down, and not every move means something significant. Sometimes it's just traders trading. And then lastly, let's talk about this from just a practical perspective. Now, what do I actually mean by this? Well, with the additions of stocks like Cloudflare and Snowflake to my portfolio, I get questions sometimes like, hey, I think you're speculating more, and these are lower quality companies. And look, I don't get offended by this. I mean, these are legit questions, but I think this is where a little bit of perspective helps, because Snowflake and Cloudflare both are examples of smaller cap tech companies that have more aggressive growth profiles than maybe the other stuff in my portfolio, and I did that on purpose. Because most of my portfolio is in mega cap tech. I mean, very strong companies, strong balance sheets, good growth, but also very large in terms of size. I mean, if you just look at my top 7 holdings in my portfolio, it's NVIDIA, Amazon, Meta, Visa, Apple, McDonald's, and American Express. I mean, each one of those is over 8% in terms of weight, while Cloudflare and Snowflake combined right now anyway are less than 8% together. So the point I'm making here is that it's a much smaller part of my portfolio, which means that the overall risk to my portfolio is much smaller, and that's one of those things that helps me kind of manage the volatility to where I don't really worry about it so much because the impact of it is lower. And that's why I try to have my highest conviction holdings be my largest weighted holdings, because ultimately they're going to have the biggest impact on my overall performance. And that helps me reduce the anxiety whenever markets go down. But let's just take this a step further, because I've told you all before that the portfolio I share on the channel is our actively managed portfolio, and that we have other accounts like my wife's retirement account that's only only invested in the S&P 500. So when you zoom out to the whole picture, you see that Snowflake and Cloudflare are less than 8% of my actively managed portfolio. When you zoom out to my whole stock portfolio, they're maybe closer to maybe 2 or 3%. And then when you zoom out to like full net worth, they're probably less than 1%. So when you look at it from that perspective, you can see that it's really not that big of a risk that I'm taking with those particular companies. Now, if your only investments are having your full net worth in the riskiest stocks, then yeah, it's going to be pretty stressful. And if that worries you, you should adjust your approach. Now, if your only investments were buying things that you don't really understand and you don't know why they're going down, then again, maybe ETFs or index funds or something like that is a better approach for you. I feel like people spend a lot of time trying to figure out what the market's going to do next and if it's going to go down, when for most people, the best action is to build your portfolio in a way to where you can just kind of stay the course and not get rattled no matter what the market does. Because that's the part of investing that's actually within our own control, and we should take advantage of that. So am I worried about my tech stocks? Well, no, not really. I still believe in the trends and companies I've invested in, and we'll just see what happens. Okay, now speaking of trendsetters, let's talk about the biggest one of all, NVDA. Now they just reported earnings, and I'm recording this before the market opens after their earnings release, so a lot could change by the time you see this. But let's go ahead and go over it. Now if we look at their previous guidance from last quarter, they expected revenue this quarter to be $37.5 billion and gross margins to be 73 and 73.5% respectively on a GAAP and non-GAAP basis. And then in terms of operating expenses, they expected them to be $4.8 billion and $3.4 billion. So if we look at what they actually announced, revenue was $39 billion, so that exceeded their guidance. Gross margin was 73% and 73.5%, so again, right at their guidance numbers. And then operating expenses were 4.6 and 3.3 or 3.4. So they basically were right on target with their numbers, with revenue coming in a little bit higher. Now, in terms of how they did against analyst estimates, they basically beat analyst estimates across the board. And overall, they just had a quarter that really topped expectations, both in results and guidance. And if we just zoom out a little bit, NVIDIA is a $3 trillion company that, yeah, it's trading at a 50 PE ratio, but growing earnings per share at 82% year over year, revenue growth of 78% year over year. And I mean, people keep saying that NVIDIA is so overvalued, but if you just take a look at their fundamentals compared to some of the other popular companies out there, it actually looks pretty attractive. And they're also, just happens to be one of the most important companies for the global shift to accelerated computing. But all that being said, if we take a look at what the market reaction was, NVIDIA was choppy after hours, but currently up about 2.5% in the pre-market the morning after. Now, if we take a look at guidance over the next quarter, they expect revenue to be about $43 billion, which would be about a 65% year-over-year increase from last year. Gross margins are expected to be about 70.6 to 71%, which is a little bit lower than you would expect. And operating expenses expected to be $5.2 billion and $3.6 billion. So overall, what are my thoughts on this? At first glance, NVIDIA had a really great quarter. I mean, revenue and margins are great. Even the forecast, I think, is really strong. But the one thing that kind of stood out was that operating margin guidance was a little low, which could be a cause for worry if it means that they're losing pricing power or maybe costs are rising. But they actually talked about it in their earnings call, saying as Blackwell ramps, we expect gross margins to be in the low 70s. Initially, we're focused on expediting the manufacturing of Blackwell systems to meet strong customer demand as they race to build out Blackwell infrastructure. When fully ramped, we have many opportunities to improve the cost, and gross margin will improve and return to the mid-70s late this fiscal year. So it's one of those things where on the surface, it maybe doesn't look that great, but they have a reasonable explanation for it and expect it to improve going forward. So overall, NVIDIA is just a beast. And when I bought it about a year ago, I said that I thought their growth story still had potential. And at least up to this point, that's been true. But this is a very polarizing stock, meaning you have people who have very strong and sometimes irrational opinions on both sides. Some think it's going to $80 trillion or whatever, while others think it's a bubble and it's going to die. So what that means is that if you hold NVIDIA stock, you really have to deal with a lot of noise almost every day. I mean, just over the past few weeks, whether that's DeepSeek is going to totally kill the company, Singapore revenue and China restrictions, hyperscalers are building their own chips, on and on and on. And it's one of those things where if you're not really sure about why you bought the stock or why you invested in them, then it can be really hard to deal with. I mean, NVIDIA dropped like 15% in a day because of DeepSeek. And if you remember at the time, here's what I said. If anything, applying those efficiency gains can help accelerate those fields past their current obstacles. And it's just hard for me to believe that NVIDIA is not going to be a big part of that. I mean, at the end of the day, you can't convince me that DeepSeek doing something amazing on NVIDIA hardware is ultimately bearish for NVIDIA long term. And now we're hearing that DeepSeek actually did increase demand for NVIDIA chips, not decrease it. And when you look at the response of xAI's Grok 3 model, it's been amazing. And that was done with a super cluster of NVIDIA GPUs. So to me, NVIDIA continues to prove that they're one of the most companies in the whole world, really at the head of this global shift to accelerated computing. But the stock is very volatile. There's a lot of strong opinions on both sides. And it's one of those things where you're going to have a strong stomach if you're actually holding it. All right, so next up, let's talk about Snowflake. Now, I just went through my deep dive of the company, but let's look at how earnings went. So if we just go over their previous guidance, we can see that they expected product revenue to be around $906 to $911 million with a operating income margin of 4%. So if we take a look at what they actually reported, we see they reported product revenue of $943 million, beating their guidance and having a 28% year-over-year growth rate. Operating margin also beat their guidance at 9%, so it actually beat it pretty handily. And if you remember from my guidance first results slide, this really shouldn't have been a surprise because Snowflake tends to beat their guidance each quarter, at least they have for the last couple of years. And if we just compare to analyst estimates, Snowflake beat Wall Street expectations across the board and expect their strong growth to continue. And real quick, if we just take a look at their infographic here, because I think it has some good stuff on it, obviously they show their revenue growth both at the quarter and year over year, which was 30%. Their net revenue retention rate was at 126. Total customer growth was 19% year over year, but I think more importantly, their customers that spend over $1 million a year grew at 27% year over year, which I think is really good. Also, the number of marketplace listings grew 26% year over year, which is excellent. And they just added this, I think, this quarter for the first time, basically AI ML adoption or number of accounts that are now using their AI and ML tools, which is at 4,000. So that'll be something that will be interesting to kind of follow to see how it changes or grows or what that number actually means. Now, if we take a look at the market reaction, as of the pre-market the day after, Snow was up over 13%, which is pretty amazing. Now, unfortunately for me, I added Snowflake back a couple of weeks ago before the big downturn, so this is really just kind of getting it back up to my initial entry point. But if you were one of the people that got interested in Snowflake after my deep dive video and you actually bought into it, then you got a nice little bump here at the start, which is always fun when it happens. Now, if we take a look at their guidance for next quarter, we see that they expect product revenue to be around $955 million to $960 million, which would be a growth rate of about 21 to 22%, a little bit slower than this past quarter, and operating income margin to be about 5%. And if we take a look at their full year guidance, you can see they expect product revenue to be about $4.2 billion, which would be, again, a growth rate of 24%, a little bit slower than this past year, and operating income margin to be about 8%. So what are my overall thoughts on this? Now, we just went over Snowflake in detail, so I'm not going to bore you with all the same stuff again, but in general, the things that I was looking for seem to be doing well. It looks like their growth story is continuing, and it's one of those things that I'll just keep monitoring it each quarter. Because I think sometimes we get tricked into believing that because we get news and information every day, that we need to do something every day. But I look at it like, I evaluated the business, the growth story seems to be intact, they only update me on it every quarter, so I'm not going to overreact to things that happen in between those times unless it's something really big. Because when we look at their most recent earnings report, and if you watch my analysis video, then it's basically all the same stuff that we talked about. So my thought process is, I think this is a winner long-term in a strong secular trend who has clear market advantages and differentiators that are going to help it keep growing. And at least for this quarter, the things that we talked about seem to be tracking, and we'll see how they do next quarter. But hopefully a few of you at least were able to get in if you're interested and got a nice bump this morning. All right, now lastly, let's quickly talk about Amazon. Now, Amazon had a demo yesterday about their new release of Alexa Plus. Now, you might be asking, well, wait a minute, what is Alexa Plus? Well, let's take a look.
Oh, hey there.
So we can just talk now.
I'm all ears, figuratively speaking.
Cool. Do you know how to manage my kids' schedules?
I noticed a birthday party conflicts with picking up Grandma at the airport. Want me to book her a ride? Billie Eilish is in town soon.
No way.
I can share when tickets are available in your city.
Yes, please.
Got any spring break ideas?
Somewhere not too far.
Only if there's a beach and nice weather.
Santa Barbara is great for everyone. I found a restaurant downtown I think you'd like.
What is Santa Barbara known for?
It has great upscale shops and oceanfront dining.
Can you go whale watching?
Absolutely. Want me to book a catamaran tour?
What's the next step?
Remove the nut holding the cartridge.
Should I get bangs?
You might only love them for a little while.
You're probably right.
Make a slideshow of baby Tina.
Mom.
What part am I looking for again?
2-inch washers. Your Uber is 2 minutes away.
For real?
Wait, did someone let the dog out today?
I checked the cameras. And yes, in fact, Mozart was just out.
Now, they showed and demoed a bunch of stuff that it can do, but basically, Alexa is being that AI friend and buddy that can handle tasks for you, talk to you whenever you need it, and make sure your pets get properly cared for. Now, obviously, you guys know that I'm big into AI and AI tools, and Amazon's one of the biggest stocks in my portfolio, so obviously I thought this was cool. But what I really loved is they plan to offer it at a price of $19.99 a month, but more importantly, include Alexa Plus for free for Amazon Prime members. So again, this is Amazon just continuing to increase the value proposition of Amazon Prime, make it less likely that anybody wants to leave, probably justify some future price hikes, and maybe most importantly, get an instant audience and users for the new AI feature. So it's a win-win-win for Amazon the company, Prime members, and Alexa's future. And what's cool about it is they plan to use Amazon Bedrock for it, which means that Alexa is going to be using different AI models depending on which one is best for the job. And I thought this was a really cool tweak because it kind of gets us out of this mode of, oh, I'm using this one particular model, to more of like, I'm going to use an assistant that helps decide for me which one is best depending on what I need it to do, which is actually kind of what Apple is trying to do with Apple Intelligence and integrating other LMs and services into their experience. But I will say, seeing this marketed as like Alexa in your home helping you do all this stuff, it really does kind of feel like it's an area where Apple could have crushed it, but they simply don't have the product lineup of home devices that Amazon or even Google has. But anyway, Alexa Plus will be rolling out in March, and first to the Echo Show, 8, 10, 15, and 21 models, and then to other Echo devices and apps later on. So yeah, I mean, this is a space that just continues to change like daily in terms of new announcements, new devices, new features, and it's just crazy how intense the pace of change is, and it's going to be fascinating to see how it all plays out. Now, if you missed my deep dive on Snowflake and why I added it to my portfolio, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.